Hey everybody, as promised, I have another video comparing the VIX to the VXX. Volatility is awesome. They're products that I really enjoy. They're very nuanced. I'm actually talking with one of my friends right now who spent a lot of time learning about volatility, so I'm hoping to have him come on and talk to us a little bit about what he's learned, bring some of his experience to the table as well, because I absolutely respect his opinion on this stuff. But to kind of prep us for that conversation and settle up on a couple, basic similarities and differences between the two, I figure this is a good place to start. So first, we have the VIX and then the VXX. They are different. They are similar, but they are different. Let's start with the similarities, and then I'll branch into the differences. So both of them have options available to trade on them. They both track in some capacity the volatility of the S&P 500. They both are mean reverting, and they both find expansion with heightened volatility, and then they both tend to fall with lower volatility. And another thing that's not on here, but it's just velocity of movement. If I pull one up just for general context, let's do the VIX. I'm going to zoom out a little bit. This chart's a little close. So you can see it went from, essentially $14 to $85. That is a parabolic style move. And both of these products will have movements like that due to their structure. They rise and fall rapidly with changes in volatility. So now let's shift over to the VIX, some traits that are specific to the VIX. The VIX has no underlying. So what that means is there's no stock. You can't trade the VIX itself. And I can show you this because if I pull up the VIX, there are options, but notice how there's no bid, there's no ask, there's no size, there's no volume. There's no underlying here. The only thing the VIX does is track the S&P 500 implied volatility, and we can check that out pretty easily because, so right now the VIX is at 2822. So if I type in the SPX and then I go to its volatility, we see 2813. So it tracks the S&P 500, in this instance, the SPX volatility. It does have VRO settlement on Wednesdays, which is a little bit different than most options and ETFs, ETN, stuff like that. So not really a truly impactful one, but one that's good to know. So then if I move over to the VXX, unlike the VIX, the VXX has an underlying. There is stock. So if I pull this up, we can see that there's a bid, there's an ask, there's a size, there's volume, there's all the components of an ETF or an ETN. The difference between that is the fact that part of your strategy, depending on your disposition towards it, you can include holding an underlying. Now, VXX is a forward-looking projection of the VIX. So VIX, the VIX, tracks the current S&P 500 volatility. VXX is a forward-looking projection of VIX. Like a lot of other ETNs that we see, it's a futures-based product. So that means that it's in a portfolio that uses futures to track the price of the VIX. So it uses /VX futures. And what that means is it's very susceptible to drag. The reason being is that means every single month it'll look at two different futures. So I can actually show you. So if I pull up the VIX, we can see that there's the front month, which is the closest to expiration contract, and then it uses the next month, so the following expiration. And as you'll see, there's a difference in price here. So right now, we actually see a little bit of backwardation, where the further out futures are a little bit cheaper than the current futures, so there's no drag here. However, if these are switched, which they typically will be because we are generally in a state of contango, which is where the further dated futures contracts will be priced more expensively, like these. So what will happen when we're in contango is when it gets to expiration, we have to close out this front month, pay whatever it is to close, and then we have to establish a new position in the further out month. So if you can see the difference here, in this exact scenario with the VXX, we would have the portfolio will have these May 20 futures, and then it'll also have this first expiration for June 20 futures. So as soon as it's time to roll these May 20 out, we have to buy the next June expiration, which we're trading for 31.25. So if we're going to close our current position at 29.95 and then establish a new one buying at 31.25, you can see we're paying more than what we're getting. Over time, that erodes the value of the product. So that's why you'll see reverse splits and stuff like that over time to keep the product in existence, essentially. The VXX, because it's an ETN, it settles Friday, so normal settlement there. And then something else that is of note is that the VXX tends to have slightly lower volatility than the VIX. And the reason for that is because, if we're talking about the same delta option, and the reason for that is because the VXX is made up of both front month and the following month futures. So there's a little bit of a buffer decreasing some of the typical gamma risk and things like that, and is specifically vega risk in this instance, which is changes to implied volatility. So VXX has a little bit of a dampened sensation for that due to being spread across two different expirations. So I like to trade the VXX personally. It's got really good volatility. It does suffer from decay, so you've got to make sure you plan that into your strategy. I would never, ever, ever just be long shares of VXX for any period of time, simply because if you sit there and you hold it while you're waiting for some sort of big pop in volatility, a lot of people try to do that. Well, if it goes from 13 up to 78, that's a ton of money you can make. It's absolutely true. And if you time it right, there's no doubt you would do well. But the problem is you can find yourself holding it for extended periods of time every single month, it's really every week when we're rolling. You'll just see those options or the futures rolling out, causing decay, eroding the value of the position. So realistically, you're paying for it. You're not really having any sort of free lunch there, just waiting for this big pop to happen. And then this is also the same exact reason why I always caution people against being short any sort of volatility product without coverage, meaning a spread. I like to sell calls, right? If I'm bearish, I think something's going to come down. And we know that this is a mean reverting product. So you had better believe that when I see VXX at certain levels, I immediately take short positions in it. But it's always a short credit spread. So I sell and buy. And the reason is because of these binary movements, these huge movements can really hurt an account, even though you'll know it'll come down at some point in time. If your account's in a margin call and you can't successfully, add enough money to meet the margin requirement, they're going to force you to neutralize at a bad time. So you're going to have to close those positions at a bad loss. So I just don't want to expose myself to any of that whatsoever. So I am always interested in shorting stuff like the VXX and the VIX when I see them, at certain levels, certain highs. And that's great. However, always highly recommend keeping some sort of coverage to the upside risk, because those binary moves can really, like I said, cause a tremendous change in your buying power requirement or your margin requirement. So that's kind of the big difference between the VIX, VXX in terms of their structure, how we can trade them. I absolutely, like I said, prefer the VXX. I find that the liquidity is good, and I like that there is an underlying involved, and I can also count on the decay or the drag over time when we're in contango, and I can see when that's going to happen, increase the likelihood of it returning to a mean. So I can use some of those components to help inform my strategy and decision making. So if you have any questions on either of these, let me know. Great products to add to your toolkit. There are some nuances that you got to be mindful of, but that doesn't mean we shouldn't trade them. All right, catch you guys later.